Alright, welcome to our PLB 2 hours Condo Summit 2024. This is the first ever webinar that we're doing a full 2-hour session. Yeah, and the reason is because today we're going to cover new launch condominiums as well as resale condos outlook for the year 2024. And of course, with me, you might be wondering why are there so many of our PLB consultants here. Is because each of us is going to take a separate segment, and we're going to have today's webinar in 3 different portions. So allow me to kickstart the first part first. So for the context of today's webinar, what we have done is that we are introducing to everybody a new PLB framework called the Absorption Rates. And in order for the Absorption Rates framework to take place, what we've done is that we have tabulated all the existing resale condo listings as well as their asking prices from, of course, one of the most popular property portals in Singapore. And this is correct as of the end of October 2023. So this is the new framework that we will be primarily using today. But of course, we will weave in all the other frameworks that we've been using for the entire 2023 to help everybody to make a better sense of the market. So absorption ratio, simply just for the start of this webinar, is that if the absorption rate is long, what this means is that in future, if you intend to exit from a particular bedroom type condominium that you're holding in a particular district, it might take you a longer period to find a buyer. If the absorption rate is shorter, then it will be easier to exit. So this absorption ratio later we will be explaining in detail, but what is good to know is that all the major frameworks that a lot of property research are basing on are past transactions. However, in Singapore, past transactions do have a lag time period, all the way starting from the option date to the completion date to the dates that the stamp duty is paid, as well as the caveat lodging date. So usually, when you see certain figures and transaction numbers, they have a laggard effect of between 1 to 3 months. So we also have to take a look at the existing current inventory in order to have a complete picture, which is why we came up with the absorption ratio. So this allows us to have different data points like this. And this was a landed webinar that we have just completed. It allows us to look at the amount of listings currently in the market for different landed property types in every singular district. And for today's context, this is an example of the CCR current supply level. These are properties that are still available in the market, meaning that this belongs to existing sellers that are listing their properties on the property portal. And just a quick disclaimer is that property portals sometimes do have certain duplicated listings because sellers might appoint multiple brokers to help them market their properties. So it will be good for us to make an assumption that we have to reduce about 20% of the listing count from this. But for the context of comparison, we will just take it as a full amount. So for example, in CCR, there are currently 3,542 2-bedrooms for sale at the moment, 3,330 3-bedders for sale at the moment. And what does this mean for us to make a decision next year? All right, and at the end of today's webinar, because this webinar is going to be 2 hours long, what's going to happen is that we will have this 87 charts available through one very simple method. And later on in the mid-section, towards the tail end section of the webinar as well, you also start to realize that certain bedroom types in certain districts have lower absorption rates, meaning that they will take longer to find a particular buyer for this particular bedroom type in a particular district. Some have extremely high absorption rates in the sense that it will be easier to find a buyer next time if you want to exit. Now, why is this framework important is because let's say if you're hunting for a 3-bedder and you are okay with maybe 2 to 3 districts that you have already highlighted and selected, it is important to find out which of these 3 districts have an easier kind of route for you to exit next time in 3 to 5 years time. Because you don't want to own a 3-bedder maybe in this district that has very low demand in future. And when you want to sell and you want to upgrade to a 4-bedder or landed property, you find that because of the fact that you are owning this particular type of bedroom type, it is very hard to find a buyer. It takes at least 12 to 18 months to find a buyer, and thus you lost your opportunity in the next phase of your property investment journey. So it is thus important to find certain categories with higher demand level. And this is the simple method that later on at the end of today's webinar we'll share with you. So you just need to scan a QR code. You'll be able to gain the access to the full 87 charts through this very simple method. A very quick introduction is if this is your first time joining PLB webinars. This is the 19th webinar that we are doing. And of course, we have another 2 live debates that we have completed. This year, we have also completed our landed convention as well as our client appreciation event. So quick introduction on myself. I have been in the market for 16 years. Currently, I run 2 companies, PLB Media as well as PLB Realty. And of course, today with me are my senior consultants that has been very experienced in the market. And later on, as we deep dive a little bit further, they will come in and share different perspectives and viewpoints. And we hope that by the 4 of us combining our experiences together, you will have a great takeaway today. So this is our media team, our realty team, and of course, recently we have been awarded top landed transactor in Singapore for 2 years in a row. And these are our 3 channels, our NOTG, PLB Insights, where we talk about new launches reviews, as well as our main channel, where you get to see all the different kinds of home tours. So this was an event that we have done in May this year. We had about 370 public participants, landed lovers that came. We are going to hold our landed convention in 2024 May as well. And this was our recent Cannes event that we had about 540 of our clients that came for the year-end appreciation event. So Rong himself, he is a senior investment consultant in the market for more than 10 years, very experienced when it comes to portfolio strategy as well as management and expansion strategies. Wayne, he is one of our main presenter and anchor in our PLB Insights new launch review series. So later he'll be sharing a lot more about new launch. Joan is a very experienced consultant with us, also specializing in marketing homes as well as planning portfolio strategies for her clients. So 3 main things that we'll talk about today. Number 1, new launch projects. We want to look at the performance of 2023. What's going to happen in 2024? 2023, we have 47 new launches. What about 2024? Number 2 is that, are there disparity between these 3 different products? Resale, TOP projects as well as new launches. And how about the district's disparity? Number 3 is that we're going to introduce our frameworks so that you can use all these frameworks to look for and hunt for a condominium investment. Now, 3 products when it comes to condos, and we're going to focus on these 3 today. Resale condos, TOP condos, meaning that they just reach its completion stage. The buyers that have purchased them about 3 to 4 years at the show flat, they are collecting their keys. And if they put their property in the market, we call them TOP condos. New launches are direct from developers. And then, of course, we'll look at 3 different regions, OCR, RCR, and CCR. And this is, of course, what we call the pairing strategy. What do I mean by pairing strategy? Now, every season or every year, there is a pairing that will have one of the highest potential. It could be one pairing or it could be a double pairing. So we're going to hunt for that pairing, or maybe we're going to hunt for the multiple pairing. Hopefully by the end of this webinar, we'll have some clarity and see what should we go for in 2024. And why is it that pairing strategy is important? It is because any investment, even though we want to buy a condominium for our family, for our kids to stay, enjoy the lifestyle, or maybe for capital protection, upgrading from our HDB, or maybe we just want to park the capital in an asset class that has lesser supply, this is still one of the underlying principles that a lot of families will hope to have, meaning that nobody will want to buy a condominium and 10 years later, you buy at $2 million and you can only sell at $2 million 10 years later, because you cannot even fight inflation. And you cannot even fight the cost of your funds if you were to leave it in your bank. So basically, everybody will hope that when they want to exit, firstly, they have an ease of exit, because we also don't want to put our property in the market and we cannot find a buyer for 18 to 24 months. It can be very frustrating. Number 2 is that we also hope that we can at least have a 3 to 5% appreciation per annum. So these are the 2 fundamental principles that we hope to achieve for everybody. Now, recently, of course, if we were to look at the price trending for 2023, there seemed to be a couple of opportunities as well as a rationale for why these opportunities arise. For example, certain classification might be a little bit too close to the next classification. So for example, if we were to look at resale, 1420 PSF on average for OCR condos, this is quite a huge gap towards all other classification. And of course, if you were to look at new launches for OCR, it also seems to be quite a close gap to a CCR kind of resale PSF median range. So that could present some opportunities in certain segments. We're going to deep dive. Now, what has been, of course, the performance in terms of private properties? Now, you see this slight dip. That was basically for the detached category for landed. We have explained it in detail in one of our NOTG episode. You can reference to that. But overall, in terms of non-landed, which are condos and apartments, it has still been performing well. In terms of its quarter-to-quarter appreciation performance, there's still a single-digit growth. And this is basically the resale volume for 2023. We will be ending the year somehow similar to 2020, which likely we should trend at probably about 11,000 or maybe about 11,000 plus units in terms of overall resale volume. And this is the current median PSF of all resale properties in Singapore for condos and apartments, which is at about 1,562 PSF. This is the sub-sale volume. If you notice, sub-sale is pretty high. One of the rationale is because this year is the year that there has been a lot of TOP projects. So when TOP projects are being released in the market, if the owners were to put them for sale, this category usually is very popular because this is your chance to own something that nobody has lived in before, and it's a brand new property ready for own stay. And then, of course, this is the new sale volume. So in terms of new sale volume, is about 6,000 plus. We should end the year at about 7,000 plus. Average PSF right now is about 2,391 PSF. So overall, we could see this year quite similar to 2020, but not forgetting for the fact that 2020, our interest rates was only about 1.5%. This year, our average interest rate is about 4.4%. So what could happen next year if, for example, Fed were to reduce their interest rates? So what we have done also is we have categorized in terms of bedroom types for OCR. These are the bedroom types price point over the years in the OCR district, and we have segregated them from 1 to 5 bedrooms. This is RCR. This is CCR. Overall, every bedroom type has trended up in terms of PSF level. And just a quick recap is that it is also important to look towards the next 7 years and pre-plan in advance on the type of property that you want to hold. Because what is going to happen is we're going to have 50% of our foreigners, investors, as well as foreigners, professionals that will be residing in Singapore. 50% of our population will be Singaporeans. And condominiums will still remain the class that will suit all citizenship type. Whether it's Singaporeans, PR, foreigners in Singapore, foreigners not in Singapore, it is the only asset class that suits all international audiences. And condos will still be a class that we feel that it is more inelastic, it is a harder asset, because in terms of the overall quantity, vis-a-vis the overall residential supply is still considerably low. So what is going to happen is that I think it's important to hunt for the asset classes. For example, like landed, there's only 73,000. Condos with high appreciation potential, together with, of course, this Q3 and Q4 category, there's a total of 360,000 condos available. But we want to focus on this type because there are condos that you could have entered in, but you find that your rental yield is extremely low and the appreciation is low as well. There are some condos with high rental yields, but when you want to sell it, you just realize that the valuation does not improve. So we want to hunt for this class of condos in today's webinar. And overall, I think in terms of what is happening in the market is getting very sticky. Why is it getting sticky? Is because existingly, we have close to about 80 over 1,000 condominiums and apartments being held in stock by foreigners, companies, as well as permanent residents. And bear in mind that right now the ABSD for foreign investors is 60%. Most of this 80 over 1,000 units were purchased before the ABSD was introduced. So the natural psychology is that they are not going to sell it, because if they were to sell it, they cannot buy, they have to buy back at 60%, whereas before that, they've already bought in at about 10, 20, 30% ABSD at a lower ABSD. So naturally, they will tend to hold it or they will rent it. And currently, Singaporeans are holding about 262,000 in terms of the overall stock. So this year has been a conflicting year. We've seen a couple of banks collapsing in US. We also have further cooling measures for HDB as well as ABSD for private properties. And interest rates has been naturally high this year. But of course, we also see news like this, which is very conflicting, because towards the Q4 of this year, certain launches are still performing extremely well. And this in the OCR district, Jada has been sold at an average of $2,451 per square foot, 88%, so very good performance. And overall, we are having about 15 to 16 rounds of cooling measures. Very hard for our government to reduce any cooling measures because it will open a floodgate for foreign liquidity to flow in. And this is, of course, some of the news that you have seen, some of the good news from overseas in terms of overall demand, as well as Singapore household wealth overperforming global cities. And last but not least, our median income is the strongest out of 30 global cities. So this is, of course, one of the good news that might happen in 2024. And I think it's very important for us to take note, because if interest rates were to come down next year, and if our mortgage rates are reduced downwards, it's going to create some level of, I would say, anticipation. Existing home sellers might be a little bit more bullish. They might want to raise their asking prices. Developers might get more bullish. Buyers might come back to the market. So I think it's important to make certain kind of decisions right now so that you are prepped to take action. And last but not least, this is the forecast from a couple of banks recently. UOB also released their latest forecast as well. And they forecast that towards the tail end of 2024, we might start to see interest rates tailing downwards. So I'm going to hand over to Wayne, where he's going to come in and talk about the first portion, which is the new launch outlook. Let me welcome Wayne.
All right, so for my section, I'll be covering the new launches that have been launched this year in 2023. And there's actually, what we have collated is there's 20 new launches. In fact, it's very interesting to note that there's actually, I would say close to 50% of them in the RCR area and another 15, close to another 50% at the OCR area. Generally, there's about 9 projects that was launched in RCR, 9 projects in OCR, and basically 2 projects in the CCR area. So if you look at the numbers, we have actually collated in terms of the number of units that's being sold to date, as well as also the total number of units that's available, which basically gave us the percentage of the total number of units that are actually right now being sold in the market. So this basically gave us an indication of the performance of the new launches this year. And of course, earlier on, you have heard from Melvin that 2023 is actually a very conflicting year because the interest rate goes up. There's also cooling measures that was announced in April 2023. In fact, this project, Blossoms by the Park, was launched just a couple of days after the cooling measures of the increase in the ABSD rate from the market. So this, in fact, was actually one of the concerns from the developer. But if you realize that the news mentioned that basically Blossoms by the Park on the launch weekend itself sold out 73% of the units in a one-off area. And I think that's also the reason, because there's a pent-up demand for a new launch in a one-off where it's actually being servicing the, I would say, the professionals in the area. So fall back to the chart again. So if I look at this graph, look at this chart, you can see that there's actually some units that are performing very well. So of course, one of them will actually be Jaden. They actually sold out 89%. In fact, if you look at the number of units sold to the number of units that are available in the project, Jaden is actually one of the best performance this year in 2023. But of course, there are also some other projects like Continuum that's actually doing pretty well. But of course, in terms of the percentage-wise, it's not that high generally because the total number of units in the project is big, because at Continuum it's about 816 units. But if you look at the sheer number of units, which I'm going to share with you later on. Alright, so if you look at all the new launches that was launched in 2023, in fact, 50% of them have achieved more than 50% of the units that are sold. So if you look at this table, there's actually quite a number of things that we can take away from this table. So from here, you can see that number one, RCR is still one of the area of great interest to the buyers for new launches. In fact, D15 is one of the area that's been performing well. In D15 alone, there are actually 3 projects that was launched. Tembusu Grand, we have Grand Diamond, and of course Continuum. Out of which Grand Diamond and Tembusu Grand basically achieved more than 50% of the units transacted. But of course, over here as well, you can also see that Wharton House, which is one of the niche project that was launched this year, is a huge land plot. It's a freehold project in the D15, up in a very exclusive area. In fact, this is one of the projects that has a lot of people talking about it in the D11 district. So once they were launched, in fact, it was actually a private sale event that they have not opened up for public launch, and they have already achieved 60% of the result. Reserve Residences is an integrated development in the Upper Bukit Timah area, and this also has achieved a very good performance. Likewise for Jaden, which over the last 10 years, there wasn't much units that was being launched in the area, and this basically proves that pent-up demand is there for new launched in those areas. So of course over here you can see that there's also several other projects. In fact, you realize that North area there's no new launches. So Blossoms by the Park is also one of the new project in the One North area that has been targeting towards the investors, because over there's not much new launches as well. Since the last one was actually One North Eden in the area. So all in all, these are basically the new launches that's been performing pretty well, of which there's a mixture of unit development type, from very rare freehold project to a huge land size to integrated project, as well as also one of the very popular district D15. The next numbers that we have actually consolidated is actually we look at the performance of projects by units sold over the launch till now. So of course, Reserve Residences is one of the best performance, sold quite a fair bit of 645 units. Grand Diamond, Lentor Hills, and of course, out of these listings over here, all of these projects over here, you have 2 projects in the D15, which you can further see that there's actually a lot of demand for new launches in the D15 area, plus also Jaden, which is also one of the projects that was launched over the launch weekend, and it has actually sold out close to 90% of the units. Back to this chart again, just to take note that Altura is actually an EC, and henceforth in terms of the median PSF is below the $1,500 mark. But all in all, if you to look at the overall region perspective, in terms of the OCR, you should be expecting for the new launches this year to trend between the range of 1,007, which is one of the most affordable new launches in OCR, which is Ardent, all the way to as high as probably 2004, which is more towards Jaden in terms of median PSF. In the RCR area, you'll be able to get something below the $2,000 mark, which is at $1,995, and that is basically Lavender Residences. And that stretches all the way up as high as 3003, which is TNW Maxwell, located in the Chinatown area. But of course, if you look at something that's more below $3,000 PSF, that's basically Continuum. That's a D15 area. In the next few slides, I'm also going to share in terms of the bedrooms type, in terms of the median asking price right now for the remaining units, as well as also the PSF. On average, one bedders now are all trending above the $1 million mark. In fact, there's some that is already exceeding the $1.2 million mark, which is something that you could have got for 2 bedrooms. And now if you look at the 2-bedroom median asking price, you can fairly see that it's all in a range of $1.2 million. So if you want to get something that is within 1.2 to 1.5, there's still some options available, like Lake Garden, once again more towards the OCR area, as well as also Lavender Residences, which is very close towards Boon Keng MRT station. So that is actually some of the options that's available. Orchard Sophia, this is the only CCR project that is being reflected in 1-bedroom and 2-bedroom, because Wharton House, the smallest unit size is actually 3 bedders, right? Which brings us to the 3 bedders median asking price. You can see that actually the price has actually moved upwards. In the 3 bedrooms listings, most of them are actually within a range of 1.5 million all the way up to as high as 2.5 million. So for Jaden, this particular chart exceeds the $3 million mark, because this is actually a high floor 3-bedroom unit in Jaden. So this is basically one of the very unique unit in Jaden that's available. And in the RCR area, that's all trending towards the $2 million, above $2 million all the way to $2.5 million mark. So the next one that we have is actually 4 bedrooms. Likewise, again, you can see that the OCR pricing is actually trending between 2.5 mil to $3 million, and this is basically the new launch pricing for 4 bedrooms right now. Jaden, once again, this is basically more for the one of the high floor units that's asking at 3.6 million. But otherwise, for the RCR area, the pricing is very much, I would say on average, is above $3 million for a 4-bedroom. Last but not least, of course, the 5-bedroom units. This is actually priced. You can see that I would say that most of them will be above the $4 million mark for the RCR. If you still want to find something that is a very affordable 5 bedrooms, you can actually consider the EC, which is Altura at $2.2 million. So right now, this is actually the most affordable 5 bedrooms that you can get of the new launches in 2023. So of course, if you look at PSF, of course, some projects is by PSF Play. Right now, you can see that on average for a 1-bedroom, $1,800 per square foot, all the way up to as high as $3,000 for TNW Maxwell, which is very much in the central region. Then of course your 2 bedrooms are PSF wise, the most affordable one will actually be Botany at Dairy Farm. And of course, Continuum is one of the higher price PSF. But all in all, you can see that in the RCR area, the average PSF is between $2,100 per square foot all the way up to as high as $3,000 per square foot for the RCR for 2 bedrooms type. Today, if you're hunting for a 3 bedroom, of course, naturally, you can see that Altura will actually be the most affordable projects for 3 bedrooms, for 4 bedrooms, as well as also for 5 bedrooms, largely because of the nature of the development being an EC. And that's the reason why the entry price is actually much lower than the rest. But all in all, on average, you can see that at the average PSF for these new launches for 3 bedrooms, 4 bedrooms, as well as 5 bedrooms, they are all trending in a range of $2,000 to $2,600 per square foot. And largely for a 5 bedrooms, you don't really have much options available. So you can see that on average wise, it's all in the range of $2,000 to $2,500 odd dollars in terms of the PSF. So with that, this is basically the new launch performance in 2023. I shall hand it over to Rong to share a little bit more on the new launch 2024 outlook.
Thank you, Wayne. So take note that all the prices that are being shared by Wayne, these are all of course subject to availability and subject to developer change in pricing as well. So you take it as a guide at the moment. So in 2024, we are going to touch on like what are the potential new launches that are coming out in 2024, because sometimes you might be thinking whether are there new kind of supply in districts that we haven't seen before in 2023. Like for example, Northern region has no launches so far, and a lot of RCR launches have been segregated in the District 15 area as well as the District 21 area. So just to have a quick recap, this in terms of the various segments, these are the new launch pricing from EC, OCR, RCR to CCR condos. And you can see that this has a healthy baseline being formed. So what I mean by that is, the reason why nowadays OCR is able to have a starting price of 2,000 per square feet, because we are properly being supported by the EC new launch pricing, which is at about 1,004 PSF. Coming up to next year, this EC base will start to move up, and hence to create like a new support for the OCR region. And of course, in different region that we see, there's always a spread in terms of the per square feet, and it is up to us if we are buying a property to have maximum appreciation as well as the ease of exit for us to carefully select which project and which unit within a project to find the disparity, which we'll cover later on as part of the webinar. Coming up in 2024, of course, you'll be asking whether are there going to be more options. These are some of the new launches that we have tabulated for 2024, and there will be 3 different pricing, because the dark blue ones is actually the land bid pricing for each development, and we estimated what will be the potential break-even cost. So what do I mean by break-even cost? Because developer will put in construction costs, financing costs, marketing costs on top of what they have purchased for the land. So that will be demarcated by the medium blue kind of like color tone. And if we were to estimate to add on like a 20% potential profit margin that the developer is aiming at, this will be the likely average launch price of each development demarcated by the light blue zoning. And of course, I was just going to share with you maybe some of the key launches that probably a lot of people will be anticipating in 2024. So one of them definitely will be the former Chuan Park en bloc site. So in that area, in the northeastern area, that is close right beside the Lorong Chuang MRT station, this is a 900 plus over unit kind of project. Usually, mega developments are well anticipated, especially in an area where there hasn't been launches over in the last 7 to 8 years. So Lorong Chuang definitely is one. Other big sites that we can look forward to, of course, is like the Marina View residences. So it has also been some time since, like Marina 1 residences have been launched in the CBD area. So we are going to expect another 900 plus units that is coming out in the CBD zoning. And how the CBD landscape is changing recently with the CBD rejuvenation plan, as well as lots of white site in the Marina Bay area, gives potential opportunities that we can potentially look out for in new launch in the CBD, especially if the PSF price gap with the RCR region is pretty close by. That could be a potential gem in 2024 to look out for. The other one that I really love is the former P Center, which is also an en bloc site. This is a 99 years CCR project, and the reason why I think that this is interesting to look at, 300 plus over units, and over here is that based on the en bloc pricing, developer could launch it as low as below $2,300 PSF, and so depending on what is the launch strategy of the developer, it could be something where we can have like a gem PSF as well as a quantum play for something that you can look out for in the core central region. Coming up is also in the District 15 area, we have seen a lot of launches that is in the condominium, as well as your Tembusu area. But if you are specifically a freehold lover who wants to stay in the Mayor stretch, 300 plus units, then this former Mayor Park M Block site will be something that is interesting for you, because the last time we saw a launch along the Mayor area, that will be about in 2019 region. And last but not least will be Lentor Garden. So for somebody who is still looking out for like an OCR condo at a very attractive kind of entry pricing, of course you understand that Lentor Gardens, we already have 5 plots of land that is being bought over. What makes Lentor Garden something that could be interesting is because if you are still looking for a Lentor project that you can be within 1 kilometer of St. Nicholas, then Lentor Gardens, half of the projects will actually fit that criteria. Because as we know that Lentor Hill Residences is performing very well, 70% has already been sold. Hillock Green, that is not within 1 kilometer distance of St. Nicholas, have also achieved about 38% kind of sales rate. So if you want to have more options within 1 kilometer of St. Nicholas, this is definitely another project that you can look out for in 2024. And so now I'll pass on to Joanne to share some should we time the market case studies.
Okay, thanks, Rong. So I think after understanding a little bit about how 2023 the new launches have performed and some of the forecasts that we have for 2024, I think at this point on a lot of your minds might be the question, whether or not we should wait and hold out our purchases. Should we time the market, or actually should we make a strategic decision to enter once we are ready to do so? Of course, everyone loves and hopes to time the market. And I think the most important question is, should we follow this sort of strategy like what we see very prominent in the stock market, and should we apply the same strategy towards the Singapore real estate market, or should we employ different other analysis tools? And I think at this point, it really pays to then deep dive into the fundamentals of the real estate market. For the stock market, it's typically more volatile. There's a lot of fluctuations in the market. Your barriers of entry and exit are also way lower compared to the real estate market, because within a single day, within split second, you can easily make your trade in, trade out, cash out within the day itself. However, for the real estate market, typically it will take months for a transaction to complete. So in terms of timeline wise, that's the difference. The other main difference that we want to highlight as well is in terms of your capital that is required for stock market. Easily these days, I think the policies and regulations have made it very accessible and convenient for retail investors to enter the stock market, to participate in the market. Just within a couple hundreds of dollars, you can already make your trade. However, for the real estate, even if we are talking about the sort of a lowest quantum kind of segment, for your HDB market, that already comes up to hundreds of thousands of dollars. So I think in terms of the capital outlay, is also vastly different. So understanding that also allows us to appreciate that then the real estate market is definitely more illiquid in that sense as well. Because of all these different factors, therefore, we do think that the strategy to invest in real estate market will be vastly different from what you're employing within the stock market because of the difference in pricing behaviors. And at this point, we also want to then reiterate the core fundamentals, because understanding the whole macro landscape of our Singapore real estate market will allow us to then understand all the different micro factors that affects the project's performance as well. For Singapore itself, most of the home residents actually start off via the HDB route. Within the whole entire local landscape, we have about 1.1 to 1.2 HDBs, and typically for a resident, after hitting that 5 years of MOP, they will aspire to move up gradually towards the next year, which is the condo, and then maybe a couple years later, once their financial position allows, then they will look towards the landed market. So for Singapore itself, the other key thing to highlight is that our home ownership rate is also extremely high, and that also affects in terms of the overall landscape performance, being that we do see a lot more ownership kind of bias as compared to investors that are in the market as well. And I think at this point, then it is interesting to identify which sort of investment methodology camp are we as buyers waiting outside on the sideline more inclined to steer towards. Are we more of the buyers who are, looking to time the market, looking to go in at a good entry timing? Or are we someone who believes that there is the right thing to buy in every season? And what is most important is to focus on the correct kind of entry pricing. And of course, I think a lot of our clients that we've spoken to, or a lot of feedback and comments that we hear in the market, a lot of opinion, they all boils down to the fact that there are certain buyers in the market who believe that, you know, the property market goes on in a cycle. There's a pattern. Every 9 to 10 years, there will be a huge crash. I want to wait for the next dip. I want to wait for there is a fire sale in the market before I enter. I think that is something that I see in the history. I think there are some buyers who definitely still stick to that kind of mindset. But through the years since 2009 to date, I think we have already been through 14 to 15 different rounds of cooling measures, and yet just looking at the charts, the property price index for Singapore is still very, very strong, still trending upwards. And I think what we are seeing back pre-2009, where there is a huge crash and there's a lot of volatility in our property landscape, is unlikely to happen again, because even with so many measures put in place, with tighter regulation, we don't see a huge drop in the market. And in fact, the opposite is true. With all these tighter regulations, it has strengthened the integrity of our property market and allowed the prices to remain more stable and to gradually trend upwards. So we leave that thought with you. The other thing that we want to talk about is also in terms of timing the market. Of course, we can analyze all we want. However, there is definitely one thing that works against all of us as investors, and that is time. And in fact, time is the only thing that we cannot buy back. And why do we say so? For certain buyers with the mindset of timing the market, from another perspective, it may also be understood that sometimes you are also playing with time, playing with fire. And why do we say so? Because throughout the years, as you hold on to your purchase and you wait for the next big crash, next big dip, the thing that is happening on the sidelines is that we are also getting, our age is also increasing, and this ultimately affects your borrowing costs in future as well as your loan tenure, especially in Singapore's context. So just have a look at this. This is just a simulation we have done, mapping out the 3 different life stages at 35 years, 45 and 55, with the same exact budget of 1.5 mil. You will see that there's a huge jump in terms of your monthly repayment as well, and almost like a double. Of course, these are exaggerated figures because we have extended the intervals by 10 years and 20 years, but the key message that we want to drive here is that the longer we delay our purchases, and as our age progresses, this will then affect our monthly repayment and also affects your cash flow as well. So here's just a case study to share where we have helped and worked with one of our clients to explore their current portfolio planning and to identify whether this is the right season for them to actually upgrade, take the move, upgrade into the next better asset for them. So in 2010, they actually bought into a BTO at Travelers Clementi area. This is a 5-room DBSS. So back then in 2010, most of the 5 rooms averaged around 735. Of course, after 4 to 5 years of construction and another 5 years of MOP, at the stage of MOP, the property has actually appreciated up to 928K, and this was in 2020. Of course, within here, you will see that there is a paper gain of about 193 odd. So I think I just want to keep, let's hold that thought over there, 193. This is another example. Let's look at Esperina Residences, another EC. This is a 3-bedder. So back in 2010, most of the homeowners at launch bought in for a 3-bedder around 850K. After 3 years of construction and then 5 years of MOP, because this is an EC, the property actually appreciated to 1.05 million. And fast forward 4 years later in 2022, we can see that based on the transaction data, the similar size have also transacted 1.4. So in essence, there is a 550K kind of appreciation as well. Lastly, let's look at Sterling Residences, another condo. At 2019, you can enter at launch at 1.735. That's about 1,006 PSF. And after 4 years upon TOP, when owners collected their keys, the property actually immediately appreciated to 2.135. That's about 2,000 PSF. And you can see that there's a 400K appreciation value. So why do we want to show all these examples? Is to really drive the message that different asset classes actually hold different risks. And for the case of our client, because they were back then holding on to a HDB actually suffers from the plateau effect in terms of the trapped equity effect. So if you take a look here, back then in 2019, of course, they can choose to hold on to their HDB and not sell. They will still see an appreciation of 100K from 928 till today is easily exceeding 1 million for the 5 rooms over there. However, because after doing our analysis, portfolio assessment for our clients and understanding that in terms of financial wise, they are ready and comfortable and in the right season of their family stage to progress to the next asset class, they decided to take the move and sold off their BTO and upgraded into Sterling residences, which then they were able to write on the appreciation of 525 on top of the gains from their BTO as well. So with that move, with careful assessment of their financial situation, with the comfort level of the family, their readiness to upgrade, they decided to make the move, and this allowed them to actually write and see the potential appreciation for in terms of their family's portfolio. So I think the main takeaway from this case study is to understand that doing something is definitely better than not doing anything with your portfolio. Of course, a disclaimer here, we're not to say that anyone holding on to HDB definitely must make that move. I think the key thing we want to drive at is to be flexible and open to different options that we can have at different life stages and to do thorough assessment of our entire portfolio and to see what is the most optimal decision that we can make at any stage in time. So in essence, our methodology at PLB is always to be in the market and to build your wealth through inflation as well. And before I wrap up this section, this is just a small little teaser on some of the framework and tools that we use to identify projects, identify entry prices for our clients. So I'll leave you with that and I'll pass on to Melvin. Thanks.
All right, so thanks, Joanne, for the portion of timing the market. Now, this segment, we're going to talk about if there are any good locations to enter based on disparity of districts. And we need to talk about absorption rates and how do we utilize this framework. Now, the very first thing is that back to the pairing strategy, the first segment we want to look at is the resale CCR condos market. So let's have a quick look. Now, based on the absorption rate theory and of course the statistics that our research team has tabulated, these are basically the first level of research that we have done. So we look at the traditional way of looking at things, which is to look at the number of transactions in 2023. Now, 2023 has almost the same transaction level as 2020. Take note, 2020 is the year that COVID was the main topic. And in terms of transaction volume, 2021 was the highest because there was a lot of pent-up demand. Transaction volume basically doubled. 2022 transaction volumes were still good, but 2023 is a very good year to look at data. Why? Because 2023 is like the combination of all the black swans that we can find. There are two wars going on right now. Interest rate is at the highest. We are full on our 16 round of cooling measures. ABSD is the highest as well. So I think in terms of transaction numbers, it is also easier to look at a conservative year. So we don't want to take like numbers from a very bullish year. Let's take a number from a very conservative year. So if you look at the first 9 months, in terms of CCR, 9, 10, 11 is still the healthiest in terms of overall transaction volume. D1 and D2 is a tad lower in terms of the amount of transaction volume for 1 bed, 2 bed, 3 bed, and as well as 4 bedder. So let's move on to the next stage is that we want to look at the current available listings. So 910 also has a large number of 2 to 3 bedders in terms of competition. So this is just to note because why? Let's say you are planning to buy a 2-bedder in 9 and 10. You also want to take note that it takes a longer period for this listing to be cleared out. And thus, if you want to list your property in the market in future, you will need to make sure that you position your property differently to stand out from the crowd. Because let's say you have a 2-bedder in District 9, you need to compete against another 881 listings currently in the market. You must find a way to stand out through a combination of positioning as well as marketing kind of campaign. So this is just something to note. Later, I will give you the final kind of summary. Third chart that we want to show is basically the absorption ratio. So take note of these red color boxes that we've highlighted. These are the bedroom types with slower absorption rates. So basically in D1, 2, and 4, there are seemingly a little bit more slower absorption rate because if you take a look at, for example, 2 bedders in D4, it takes 309 months for 2 bedders to be absorbed. So what does this mean? This basically is a tabulation between the current amount of listings that are listed in District 4, 2 bedders for sale, versus the absorption rate for the first 9 months. So this, another way to look at it is basically like this. So for example, if let's say you are somebody that owns, let's say you are a real estate, kind of like a warlord, and you own all the two-beders available in D4, and you own all 172 two-beders. And maybe you come to PLB and ask us, hey Melvin, what is the demand level for two-beders in D4? So I will reply to say that, in the first 9 months of this year, 5 two-beders has been absorbed, meaning that there are 5 successful transactions by 5 buyers that have bought within the first 9 months for two-beders in D4. But currently, let's say if you have 172 two-beders in D4 and you want to know what is the time period for your 172 listings to be fully absorbed, then it will take you 309 months for all your 172 listings to be absorbed based on 2 assumptions. Assuming that the current listings remain the same, because every month some of the listings will be sold, some listings will come into the market. Second assumption is that we base it on the same rate of absorption based on the first 9 months of this year. So when we look at that data on this level, it will then give us a little bit of picture on the demand and supply ratio on which can move faster, which can move slower. So take note, it might be safer to stick to 9, 10, 11 if you're somebody that loves the CCR market. And currently, for CCR 3-bedroom PSF, this is a median range that is at about 2,341 PSF for the resale CCR market, which, if you notice on our first few slides, we talk about Jaden, which is doing very well, 88% sold, averagely 2.4, but actually there are certain PSF levels that are actually higher, 2.5, 2.6. And this presents an opportunity for CCR lovers, because if you're hunting for CCR, you might want to look at some of the 3-beds in the resale market. Now, there is a PSF gap between CCR and OCR. What is this PSF gap? Basically, if you look at CCR, in the primary market, this is the new sale market, 2.7, 2.795, 2.8. These are for the 900 to 1,000, 3,004 square feet kind of new launch PSF level. You look at the secondary market is about 2,000 all the way to about 2,001. So compare to some new launches in, let's say, the OCR region, which is doing at about 2.3, 2.4, 2.5. This also presents a certain level of kind of disparity that you might want to take advantage of in this season. So take note, we're not saying that you cannot buy OCR new launches. Basically, we're hunting for disparities within every season, because disparity theory means that at certain time period, certain products will start to move upwards at a faster rate. They will then hit a stagnation level, and then the next category of asset class, they will start to move up. So they usually move in seasons, and everybody has its chance to move up. So you need to hunt for the correct season in 2024 to take advantage of that. Now, CCR, let me just to sum up with you. The moment you see this red box, it means that these are the price points where the bedroom type competition intensifies. What do I mean by this is that, let's say if you're planning to buy a 1-bedder, take note that in CCR, 1-bedders right now, between 1 to 1.25 million, there's still 341 listings for sale. The moment, let's say you buy something at about 1.5 or 1.6 or 1.7 million, you have to take note that existingly in the resale market, there's still about 1,700 listings available. These 1,700 listings are still in the market hunting for a buyer. So it also means that if you plan to buy a 1-bedder now with an intent to exit 3 years later, and you're buying a $1.6 million 1-bedder, you must take note that it also takes time right now for all this to be absorbed first before it is your chance to exit in future. So take note that you're entering into a pool that there is still 1,700 listings available. So this is for the 1-bedder CCR market. 2-bedders, the moment you start to cross 2 million, your competition will start to intensify, because this is the current kind of inventory that's available in the market, which is about 1,200 plus listings. And then for 3-bedder CCR, the moment you cross 3.5 million, your competition naturally intensify. Up to 4 million and 5 million, there's a combination of about 1,300 plus listings that is still hunting for a buyer. And then for CCR 4-bedders, the moment you cross 7 million, competition starts to intensify. And this is of course for 5-bedders. And just to have a look at this, we also have another set of, I think, 28 times 2, that's about 56 charts for every region. So for CCR, we have 56 charts, OCR, RCR respectively. What you can see is that I've highlighted 2.5 million to 4 million in terms of its price point. There are still options available in D9 right now for 2 and 3 bidder. So these are options that you can look at in the resale market. And also just to take note that when we talk about this based on categories, we are also not biased against whether you should go for resale or whether you should go for new launch, because in every season, as we mentioned, there are certain new launches and certain resale that has potential. So D10, also quite a fair bit of options available for $2.5 to $4 million option between 2 and 3 bidders. And overall, in CCR, something to note is this. Basically, what is going to happen is that because of the fact that 60% ABSD has been implemented, existing foreigners that are holding on to their properties in D9, 10, 11 in CCR, very likely their holding power will remain. This segment will become more sticky, and they will continue to rent or stay. They will hold it, and they will not sell to replace another property because they don't want to buy back 60% ABSD. So what does this mean as well is that CCR might start to go into a quantum play season, because foreigners that wants to come into 9, 10, 11 now, technically their overall budget reduces by quite a significant amount. Last time, if you have $9 million with the 30% ABSD, you can buy something at 6.7. But now with the 60% ABSD, you can only buy something at 5.4. So CCR might then go into an overall quantum play. Or maybe some foreigners, they might wait for their citizenship to hit PR status, then they buy. And thus they might rent first. Or maybe they might want to be a naturalized citizen in Singapore, so they might wait for the application. And thus, in terms of overall demand level for CCR, if you're a Singaporean or PR, you want to go into CCR, take note that quantum play is important. Hunt for certain quantums that are a little bit more palatable, because Singaporeans, sometimes they will also go into a dilemma state that, should I go for a D10 4 bidder at about 7 million, or should I go for maybe like a OCR, RCR landed property? So basically, these are some of the dilemma points that they have. So it's important to take note of quantum play in CCR as well. And this is to summarize CCR. Basically, take advantage of PSF level between 2,500 to 3,000. Quantum, try to keep within 7 million, go for 3-4 bidders. Now let me do a quick move up to the OCR region for resale condos. So basically for OCR region, pretty interesting. Though OCR is being known for 3 and 4 bidders being the very popular type, this is the current available resale listings on the property portal. Basically, we took all the listings from Property Guru to have a look at the amount of data level available. And this is based on October. You have about 3,100 plus 3 bedrooms that are currently for sale, 4,842 bidders currently for sale. And then we have so many charts that we cannot cover for today's segment. This is just a glimpse of the amount of data that our research team has done. And based on OCR, there are a large amount of transactions primarily in these 5 districts. Now take note, in Singapore, out of the 28 districts, some districts are crossover zone. So later as we go to RCR, you'll start to notice that certain districts appear twice. So take note that primarily, when we list the districts here, certain districts has a bigger geographical area in certain regions. But later we'll clarify for you which are the ones. All right. So take note, for example, like D19, you will see that 2 bedrooms, there's like 424 transactions in the first 9 months of this year, 476 transactions. And we have already cleaned up the data. We've removed all new launches. What you have seen here are basically sub-sale and resale. So these are the actual data for first 9 months, which is actually quite a fair bit for D19. And then D18, also quite a fair bit, about 285 transactions being done for 3 bidders, 262 for 2 bidders. And surprisingly, in D19, 1 bidder, there's about 280 transactions being done in the first 9 months of the year. And if we look at the areas with a larger amount of competition, these are the current listings for sale now. 14, 15, huge number of 1 bidders for sale at the moment. D5 also huge number of 1 bidders for sale. D19 also 182, but because D19 has a high absorption rate for 1 bidder, probably this is not alarming. D19 also has about 3,732 bidders for sale. These are some of the districts, 14, 15, 16, quite a large number. Now take note, in 15, there are some crossover zones into the OCR region in terms of geographical region. So just to take note for this portion. And of course for 3-beders, D19, 589 listings for sale, 206 in D14 as well. So if we compare transactions as well as current listings, that brings us to the absorption ratio. So these highlighted ones are the segments with slower absorption types. So for example, how do we phantom this data? Let's say if you're somebody that has inclination to buy a 4-bedder in the OCR region, then you just need to come here, have a look, and then try to hunt for the ones with higher absorption rates, meaning that the number is lower. If the number is lower, means that it takes lesser months to find a buyer. If the number is very high, it means that it takes a longer period to find a buyer. So for example, D14, it takes 297 months to find a buyer for a 4-bedder because there's a higher number of 4-bedders for sale versus transacted. So these are just some figures for you to take note. Of course, when you come to our PRB consult session, you will sit down with our PRB consultant. They have access to all our charts, which are probably about 200 to 300 charts right now for this newer framework that we have. And then they will be able to sit down, go through the districts, make a selection, and then they can hunt for different numbers. And of course, when it comes to frameworks, no one framework will be perfect. Usually we use a combination of frameworks and we don't overly depend on one. These are just some data points for us to take note of. So overall, when we look at OCR, just to sum up for you, the red boxes are where the price points intensify in terms of competition level. So take note, there's still a very high number of 1-bedders that are asking below $1 million in OCR, just to take note of what price point you're hunting for. So for example, if let's say now you're out in the market looking for a resale 1-bedder in OCR, and you love this particular type of property, is asking for 1.35 million, you need to take note that if you enter at 1.35 million, not saying that it's no good, perhaps it's a bigger size property, it has fantastic views, full-on renovation, but just need to take note that currently there are 932 listings that are asking below 1 million, and they are still waiting to find a buyer in OCR. And then of course for 2-bedders, this is where the competition level will intensify. Why? Because below 1.25, there's still a good 1,000 listings waiting to find a buyer right now in OCR. And then for 3-bedders, I think anything below 1.5 is a good entry point. Eventually, this category will start to clear out, and then we'll move to a new season where most of the 3-bedders in OCR are all asking above 1.5 in the resale market. So this might be one of the last 12 to 18 months to hop onto the bandwagon to own a 3-bedder OCR for about 1.25 to 1.5 million because there are still a couple of listings available. And then for 4-bedders, basically, we think that anything above 2 million, competition will be a little bit more intense. There's still a good category here, 1.5 to 2 million. Balance 281 listings in the entire OCR region. So last but not least, for 5-bedders, very little supply available. Very hot favorite as well for 5-bedders because these are huge primary family HDB upgrades. They love it. And of course, in summary, this is the OCR resale condo summary. So try to stick with quantum play. Reason is because most of the audiences are HDB upgrading families. It's very quantum sensitive. Go for 3 to 4-bedders. And the final segment before I hand over to Wayne is that we want to look at RCR, resale. RCR resale, basically in terms of absorption ratio, what can we see here? For example, if you look at certain higher kind of like months to find a buyer, you will get to see that there are certain districts right here that is in the crossover zone. So we shall ignore this district. We shall ignore 19, we shall ignore 1, we shall ignore 23. And then if we deep dive a little bit downwards, what we can see is that, for example, 3-bedders in District 4, 128 months to find a buyer. 4-bedders, 382 months to find a buyer. And this is the price point where competition intensifies for 1-bedders, basically 1.25 and above. You'll be pretty surprised to see that there's still about 1,300 listings for sale right now, below 1.25 million for a 1-bedder. And then 2-bedders, good amount of listings, below 1.5 million. 3-bedders, good amount of listings that are below 2 million still in RCR. And then 4-bedders, quite a high amount of listings below 3 million for 4 beds. And last but not least, for 5-bedders, not much supply in general, but take note, the moment you cross above 7.5 million, there's quite a high number of listings available. So RCR summation, basically there's quite a high number of 1 to 2 bedders resale listings for sale now. You might want to take note of that. And 3 bedders still have about 1,300 listings. 4 bedders, not a very high amount, and thus it might be a good chance to hunt for some good locale in RCR that are below $3 million. So last but not least is that when you look at all this data, the final thing to note is that we don't want to buy with emotion. We just really want to hunt for the one with analysis. And we always want to plan for the exit in mind, because the moment you buy, there will come a time that you might want to sell because you want the right size, you want to change strategy where you are aging towards 55, want to go lower on your mortgage loan as well. So thus it's very important to plan for the exit first. And let me hand over to Wayne.
So for my end, let's take a look at what are the remaining units for the new launches right now. But of course, to disclaim as well that these numbers that we have, that we're going to show are basically as accurate as the time of research. But of course, there might be some of the price revision from the developers or some units that's been snapped up. So that numbers may change. So do reach out to us for the more accurate numbers at the time of your interest. So first and foremost, let's take a look at the CCR. We look at the medium PSF. So for CCR, of course, there's not much projects. Of course, you have your Wharton House and your Orchard Sophia. So in terms of your median PSF, right now for the remaining units, of course, the numbers will be very much in a high $2,000 to $3,000 per square foot. And if you look at the RCR, this is where you do get quite a good mixed. Not considering, I mean, if you do not look at TMW Maxwell, most of the new launches in the RCR area are all trending in the range of $2,300 to $2,700 per square foot. Of course, Continuum being freehold definitely will demand a higher PSF pricing in this range. The next one would actually be the OCR. Right now, OCR Jayden being an integrated development, of course, the PSF would generally be higher. But of course, if you want to hunt for something that is actually more affordable, below $1,000, below $1,500 per square foot, you can actually go for Altura, which is an EC in the Choa Chu Kang area, right? So of course, next one we have to look at in terms of quantum. So of course, for CCR, for one bedder, there's only Orchard Sophia, which is the 1.28 mil. And if you look at 2 bedrooms as well as also 2 bedrooms is also 1.7 mil. 3 bedrooms in the CCR. So just want to quickly run through because in terms of CCR, there's only the Orchard Sophia that's currently available. But if you look at the RCR area, if you are looking for a 1-bedroom unit, remaining right now for new launches, you can still get something that is very close to the $1 million mark, which is in the RCR area for Lavender Residence. Well, of course, the rest of the other projects will be all ranging between the $1.1 to $1.5 million. Of course, by Blossoms by the Park, this will be one of the higher end, I would say the top, I would say the high floor units that's actually asking for 1.598. For 2 bedrooms wise, you do get Reserve Residence, which is at the point of time, this is one of the most affordable 2 bedrooms integrated development as well. So this is something that you can go for. But of course, if you want something that is actually in the north, in the D15 area, Grand Taman is actually one of the projects that is actually quite highly sought after as well. For 3 bedroom, this will be, I would say, the mainstream. Most of the buyers they'll be interested to get in. You do get something Lavender Residence, which is a freehold development as well. This is one of the most affordable 3 bedrooms. But otherwise, Continuum will be leading the pack in terms of the pricing because of the freehold status. Right, you still can get something that is very much Blossoms by the Park in the range of the $2.3 million to $2.5 million ranged. And for 4 bedrooms wise, you can see that the pricing wise has actually been trending between a range of $3 million to $4 million. Of course, Lavender being one of the smaller development, you can still get something that's below the $2.5 million mark. 5 bedrooms wise, this would actually, Terra Hill, this is actually a very premium, big size project, big size unit, which is asking at 8.2 million. But otherwise, the main remaining units that's going for 5 bedrooms, they are all in the range of $4 million to $5 million in terms of the remaining unit. So in terms of the median quantum for OCR, right? So for OCR, you can still get a 1-bedroom unit very close to the $1 million mark. It's in the mist, right? The rest of the other project will be all trending in the range of $1 million to $1.2 million. 2 bedrooms, Of course, the Arden will be one of the more affordable ones. The rest of the other price is all in the range of $1.4 to $1.5 million for 2 bedrooms in OCR ranged. But of course, Altura being one of the the pricing will be the most affordable for 3 bedrooms and above. But otherwise, if you're looking for private condominiums, you'll be looking at something in the range of $2 million for 3-bedroom units. 4 bedrooms wise, averagely, you're also looking in a range of $2.5 to $2.7 million ranged. Last but not least, for 5 bedrooms, we have only one unit that's available for Altura in the OCR area, and that's going for $2.3 million. And once again, being an EC, the price tag is actually more affordable. So this is actually to sum up in terms of the price trend of new launches in the various districts from D2 to all the way to D27. So these are all the 1 bedroom to all the 5 bedrooms mark. So for this, of course, you can see a different price range of the asking price right now for the new launches. And this is actually for those that has just attained the TOP. Just to do a quick comparison in terms of the TOP projects vis-a-vis towards the new launch that's currently asking. So you have a look at D14. So for D14 area, which is very close to D15, this is basically the area that is above in the range in the UNOS area. D14 for 1 bedroom for TOP projects is asking for a price of $1 million. And if I do take a look back at the new launch for D14, this is asking at $1.2 million. So there's a price disparity in a sense for a new launch versus towards the TOP projects. 2 bedrooms wise for D14 is a 1.529 for the new launch. And if you look at the resale in market for a just TOP, the pricing right now is at $1.3 million. So with these two tables, if you put it side by side, you do get to see that for the new launched TOP projects, for people who doesn't want to wait, these are the projects, this is a price tag that you can actually go into the market. And this will actually be a buffer between the current available versus what is going to be the asking price for the new launches in the market. And these will be the ones that will be setting the trend where all the new resale, where all the TOP projects and the resale pricing will basically be benchmarking against moving forward into the next 4 to 5 years. Right? And with that, I will pass it over to Rong to cover the case studies, right, for investors' mindsets.
Okay, thank you, Wayne. So what Wayne shared with you regarding all the pricing of the new launch, I think that will be a great guide if you just want to have a quick overview on to explore which districts and what kind of price range you can actually find a unit that is within the budget that you're trying to work with. Of course, it should be combined with other frameworks like disparity effect as well as our mode analysis, etc. Absorption rate that Melvin has covered to determine from an investment value angle which one will provide you with better ease of exit as well as appreciation potential. So on my end, I'm covering 2 sort of like case studies from a successful new launch investment as well as investment successfully in the resale market. So investor profile, single, 32, this is back in 2019, so of course 4 years ago. And this intention of going to this move is a pure investment play, specifically looking at capital gain and not for rental yield. And with a plan in mind to actually hold the property for at least 5 years. And so we identified that, okay, for this strategy, we can actually opt to go for a new launch property because of a couple of reasons. Number one, we are not concerned about rental yield. And second thing is because at 2019, that was the period where most of the time, resale properties overall, unless you pick very successfully, do not perform as well as good new launches due to the after effects of the total debt servicing ratio that the entire property market is still getting used to. So of course, one thing that is interesting is that based on the income of this investor at the point of time of purchase, we are unable to get a 75% loan for this very good new launch project that we identified. And so, one of the strategies that we decided was, we explained that in the market, there is a segregation between own stay buyers as well as more investor buyers. And 3, 4, 5 betas, we always mention that you have the most demand in terms of own stay buyers from the upstreamers as well as the downstreamers that we will cover later by Wayne during the mode analysis. And because with this additional pool of ease of exit, we have decided that it could make sense for us to just do the pledging, unpledging strategy to help us be able to come in and afford like a 3 beta kind of quantum. And so even though on paper, his income cannot qualify for a 75% loan, but through some banking strategies, we are able to eventually help him to get 75% loan. However, of course, that will also mean that we have exceeded the total debt servicing ratio. And the next question we ask ourselves was, is this actually a prudent move for my investor client? And so we always share that to our investment client is that if this is an investment play where you are not going to stay inside, it is actually okay to leverage higher than your usual total debt servicing ratio. Rationale is because when the project TOPs, we are able to rent out the unit, getting you a secondary income, which means that most of the mortgage is actually covered by the rental. And so hence, when we account for the rental income that comes in plus the income of this investor, you realize that this ratio, according to the new total income, becomes now very extremely safe. The other thing is also, of course, what happens before key collection. The thing is because for new launches, it's based on progressive payment. Your monthly installment is generally very low before the TOP stage. So all these are all covered in terms of prudency checks that we have done before we actually decide to go for this unit. So eventually, we decided for a 3-bedder. And usually for all my investor clients, they are very interesting is that if we go to like a new launch show flat, usually they'll ask me, so Yurong, what unit to buy? And I will specifically pick a very good unit and tell them, okay, this is the unit number that we should go for by looking at the disparity of facing, the disparity between unit types, and the disparity between floor levels. So there was one question that was posed because at that point of time, this was more like a post-launch. It was not at the preview kind of phase. And most of the mid-floor units are being sold off. So there is 2 choices in terms of either we are going for either a low-floor unit, 3rd floor, 3rd floor or 4th floor, or we have to go for very high-floor units. They are like 10 floors and above. And so what happens is, there was a question that was being asked, Rong, should I actually pay more for a higher floor because it is actually 100K more, but I think in the future it will be easier to exit because I think most people are concerned about buying a low-floor unit. And so after looking at the kind of disparity between floor level pricing disparity, I told my client that actually it's okay to go for that specifically low floor unit for this project. So of course the advice will be different for different projects. So eventually we went in to the lower floor unit because I say we can actually save this 100,000. It's not because if you go for a higher floor unit means that you actually get more appreciation rate. However, I did mention that we will probably take a longer time to sell in the future. So this was the outcome. So we bought in Q4 2019, 1562 per square feet, 1.4 million. So this is in the rest of central region, near MRT kind of property. Of course, this is the kind of price point that even for like a new launch outside central region, 3-bedder, you will not be able to find in the current market condition. About 4 years later, we managed to let go at 2024 per square feet, 1.83 million. And of course, just now I did mention that we will take a longer time to digest with regards to the selling time because it is a lower floor unit amidst high competition during a TOP stage. So how long did it take us? It took about 4 months to actually sell this out, which I think is still pretty quick with the help of our staging, of course, and video to actually stand out and position this unit. Eventually, we got a gross profit of 418,000, which is actually pretty similar to high floor units. So what it means is that like, the high floor units, even though they come at 100K, they probably also sold about 100K higher. The difference and the spread in terms of the profit did not change too much. So what it means is that we do not have to overstretch ourselves just to get into a higher floor unit if this is a pure investment kind of play. In summary, the capital outlay for this investment is 395,000 and the gross profit was 418,000, leading to a 105% return on the cash investment over slightly less than a 4-year period. So this is a very good performance. The other one is how we managed to help the clients expand their portfolio from 1.6 million to 6.1 million over a 5-year kind of period. And for this investor profile, predominantly the strategy was more on like resale properties. So 2018, we met, late 40s, 2 kids. They own 2 condos, 1-bedder investment as well as 1 resale 3-bedder condo for own stay. And total portfolio size of 1.6 million. Of course, based on analysis, what we wanted to advise based on the property expansion was that we should let go of both because 1 is too old and the 1-bedder investment actually did not profit after about 7 years of holding period. So it was bought in 2011 at 720,000. When I met them 7 years later, it was still at 720K. But the good thing is that this property did not depreciate. And of course, this client managed to collect about 4 years of rental income. And so we decided that, okay, we will sell this. And because for the own stay unit, there are some personal reasons that they cannot let go at that point in time, so we decided that we will go for decoupling instead. One of the learning outcomes is that a lot of times new investors tend to make these mistakes in the sense that they always have some preference in investing in locations that they are comfortable with, in locations that they grow up in. But this might not present the best kind of investment outcome for you, because most of the reasons that I hear is, I buy in a location that I like, near my parents, etc., and near my family, so that even if this investment do not work out well, I can actually stay in somewhere that I'm comfortable with. However, if you use the correct framework by identifying using the correct data analytics, then you actually can fulfill the original outcome, which is to actually grow your asset during the said period of time. So eventually what happened was, after the one bedder was being sold off and the own stay unit was being decoupled, and so now we have one free name, which allows us to enter into a 3-bedder freehold condo in the RCR region. And of course, usually we do not specifically hunt and look for freehold properties, because based on our data, it doesn't show that freehold properties brings more appreciation within a set time horizon. But because for this client, the specific focus was to plan for legacy planning, and hence there was a must requirement to actually work on a freehold property. And so during the freehold property kind of search, what we are trying to sort of like leave out is to ensure that we do not park our funds in freehold properties that are very, very boutique, less than 50 units, that is very hard to resell on a very small land size. And hence we went to find this specific area where there's transformation down the road, transformation plan that you can look out for, as well as one of the most feasible land size in that particular district, so that we can take advantage of the volume of transactions down the road to actually push up the pricing. Okay, and of course, there's additional funds that eventually we decide to buy under trust, like a new launch property. Why new launch is because we can stagger the payment plan for the property, and hence it becomes like a 200,000+ every single year for the next 3 years, instead of a full cash investment if you are going straight into a resale property. So in 2018, after this portfolio shift, it ended up with a 3.56 million portfolio. Next up, of course, in 2021, now the original 3-bedder own stay property is now ready for sale. We managed to let it go. But something that's very interesting is that, like, remember back in 2018, that property value was 860,000. In 2021, which is actually 3 years later, it was eventually sold at 880K. So sometimes it also means that every property has their own season of growth, and what we're trying to achieve over here is continue to shift your funds around to park in the correct property. So just think of it like a different bank account. So if bank A, your bank account, the interest rate, they start paying you lesser, then it's time to make some plans to shift it to another bank or another asset class that incentivizes you to actually port your funds over. And eventually now in 2023, you can see that this 2.5 million condo that was bought 2 years ago is now worth $3 million. The originally 2 million condos under the wife's name is now 2.3. The 1-bedder in trust is now 800,000, and hence it becomes $6.1 million. So this is a case study where we are able to increase the property value predominantly through resale properties. So we are not trying to say that you can only invest in new launch properties or you can only invest in resale properties. What is most important is that in different districts, based on the price disparity between the new launch or the resale, as well as the bedroom type they are gunning for, it will present opportunities in different areas. So some areas it could be new launches, some it could be resale. So that's where Joan later will cover more with you how we actually help our clients to decipher when is it better, where new launch can have a better opportunity, and when does resale have a better opportunity. So in summary wise, there are a few key things. Of course, if this is your own scenario, number one, we don't have to just focus on freehold property purchase, because the leasehold property most of the time could perform actually even better in a shorter period of time, unless you are really in your legacy planning stage. And this is how our clients managed to switch from 1.6 million portfolio all the way to 6.1 million in 5 years' time. And importantly, it's because, so over here, it also tells that, like, even when we have certain restrictions in the type of properties that we can park our money in, most importantly is that we want to avoid the sure no properties that you shouldn't be getting into based on understanding of absorption rate, based on understanding from mood analysis, etc. And even if we don't take the most optimized decision in our portfolio, as long as we continue with the plan in mind to expand the portfolio, we are able to have still very good outcomes. So, Joanne, thank you.
Okay, thanks, Rong, for the very insightful case studies. I think that clearly gives everyone a glimpse into how we use different mental frameworks to advise our clients as well. Now, this part is going to talk about all the different frameworks. So here at PLB, we love data, we love charts. So in-house, we have developed 4 different frameworks in order to identify and ascertain whether a particular new launch is actually overpriced or is that a good entry for us to enter as well. So I'm going to cover the first 2. The first one being your break-even calculator. Now, this is extremely useful if, let's say, you are a buyer who is in a dilemma. I have a certain budget, let's say 1.5 or 2 mil, and I'm in a dilemma whether I should be entering into a resale or a new launch at this point. So with this calculator, we are able to work out all the different cash flows, the costings that's required, your expenses, and how it will play out towards the end. So just to give a quick run through, a couple of different factors that we have identified in terms of the 2 different options being your resale versus your new launch. So for resale, typically in terms of renovation, you will likely need to pump in a slightly higher amount compared to your new launch option. So that is the first thing. The second difference would be that in terms of your mortgage interest, typically for resale condos, once you take over the property, the legal ownership is transferred under your name, then that is the point where you have to start incurring your mortgage interest. So that is the expense part that will kick in. The second kind of costings that homeowners will have to start bearing would be your maintenance fees, and that is the running costs as well as your property tax. So for resale, this will be some of the factors and costs that you have to take into account. Assuming both scenario, you are having a budget of 2 million, then we work out the break-even pricing in terms of your purchase price, your buyer stamp duty, the amount of renovation that you have to put down, as well as all the running costs after 3 or even 4 years. And the reason why we are using 3 or 4 years as a timeline to calculate is also because that is roughly the kind of timing that we are looking for a new launch to complete. Of course, these days, certain launches do take even up to 5 years for construction, but for illustration purpose, we're just taking a conservative 4 years to illustrate this example. So that is for resale. And then moving on to the new launch option, typically your renovation might be a smaller quantum compared to your resale. For your interest portion, how new launch financing usually works is that usually the developer will only start calling for your installments as and when they actually progressively build up the foundations and the entire project itself. So you will see that in terms of your running costs for your mortgage interest, the bulk of it will actually come in through the later years. For your first year, it's quite negligible. You will from year 2 and 3 onwards, then that's where you start to see most of your monthly mortgage interest coming in. For maintenance and property tax, this will only kick in upon TOP itself. So with this comparison and with these numbers, this will clearly show you that based on the illustration that we're showing right here, in fact, the difference between the resale as well as your new launch option, the break-even pricing are actually pretty similar. And with this kind of result, this might indicate that actually it still does make sense to enter into your new launch, even if we have already included in your rental part, because one of the other key differences between your resale and new launch option is that during the interim, if you have already sold off your place and you have gone for a new launch, likely there will be a huge chunk of rental expenses that you will have to set aside for in the interim while your project is being built. So even with adding the rental amount over the course of 3 to 4 years, if the break-even calculator does show that the numbers for the break-even pricing is pretty comparable, then this might indicate that actually this new launch might be a good option to consider at this point. So of course, this is one scenario. And in a second scenario, let's say it's a different climate, the interest rates are right now different, the rental fees or rental market in the current season is also very different, then the result might show that then, hey, in this instance, the difference or the difference between the two break-even prices are largely different. You're talking about 200K difference in this particular scenario. Then this might indicate that within this situation, it might then make sense to go for the resale option instead. Of course, some of the numbers here have been tweaked to sort of illustrate different scenarios or different climates in terms of the property landscape that we are in. Like I mentioned, interest rates will differ, your rental will differ, and all these do play a part in influencing your break-even pricing as well. So this is the break-even calculator that we do use a lot. The second framework that we want to introduce right here would be the lease reset. And this is useful in identifying whether a particular new launch in terms of PSF level is something that makes sense and attractive for us to enter into. And the reason why we came up with this particular framework is because through our consultations, we have also this very popular question, about the pricing entry, whether or not this PSF or this pricing is something that we should enter for this new launch in this area. And it's also usually quite hard to compare apple to apple. So what we are doing with the lease reset calculator is to shed more clarity onto this disparity effect. And through our analysis, we have basically come up with these two different principles: macro disparity versus your micro disparity. So what do I mean by that? For macro disparity, largely we're talking about the entire Singapore market. We're talking about a broader picture, comparing the region OCR versus RCR and CCR, as well as, and then for micro disparity, we are then zooming down very specific into the district itself or specific zonings within a particular district. Through our analysis, our tip is that it will be helpful to focus on the micro disparity. And why do we say so? Using the lease reset calculator, if you do identify that the disparity between the new launch and the resale is huge, then that might indicate that perhaps the resale is actually underpriced. It might present a good opportunity to enter into the resale market. In contrast, if the disparity between the new launch and resale is actually very, very small, then that might indicate that actually some of the resale in the market are actually catching up quite quickly, and that might reveal that actually the new launch opportunity is a very attractive one to enter. So just an example, this is something that a case study that we have worked out for our client who was deciding whether or not to enter into Amo Residences back then. So by comparing the two other strong competitors in the area, Thomson Tree and Panorama, of course these two are your resale, 99 years, and the lease differs. So what we did with the lease reset calculator is basically to reset the tenure back to 99 years, refresh it back to 99 years, and adding on a renovation cost for your resale versus a smaller rental cost for your new launch. This will actually work out the final PSF or the true PSF if, let's say, the two older resale were being refreshed to 99 years. So with this, you can tell that actually the 2001 kind of PSF for Amo Residences is very, very attractive, and that might also explain why Amo sold so well. It's a very clear indication that this was a very investable product as well. And coming back to a more recent example, looking at what are some of the other available new launches in today's market. For Lentor Hills Residences, we also applied the same framework, comparing it to, again, resale within the vicinity Panorama and reflecting the PSF back to 99 years. Again, you can tell that actually for the PSF difference, in terms of the lease reset, is extremely, extremely close. And this is also another reason why, in terms of PSF pricing, Lentor Hills was also a very, very attractive product itself. So I think that nicely sums up the first two frameworks that we're going to introduce. I'll hand it back to Melvin.
All right, so for the final portion, we're going to talk about frameworks. And these are frameworks that you can take away with you if you are hunting for either a new launch or resale property in Singapore for the next 12 months. And I'm going to cover this first principle first, because for real estate investment, basically for every property that you enter into, if it is for the purpose of an investment kind of objective, we usually have two objectives. Number one is we want to know whether can the rental cover most part of our mortgage. And of course, secondly, is that we want to know whether will there be a chance for the valuation to appreciate in terms of overall pricing over time? So based on these 4 scenarios that we have in PLB for real estate investment, we have graded these 4 different types of property performance into the star level. So let me just share with you firstly, before I share with you in-depth numbers breakdown. The first type of property is that if you happen to own this type of property where your rental cannot cover your monthly mortgage and your price did not appreciate through the next 5 or 10 years, this is of course one of the worst case scenarios that we want to prevent. And thus when we mentioned at the start point of this webinar, there's this Q2 type of condos that we want to hunt for, chance of appreciation, and best scenario is that the rental is strong enough to cover most part of the mortgage. If you happen to own the 4th type of property, is a 3-star grade kind of property. And he's very excited about 3-star grade. You can pen into him. And if you happen to own this 2-star grade property, if your price appreciates but your rental cannot cover, it is still a very good return on your capital. And the base scenario is that even if your price don't appreciate, but at least if your rental can cover for most of your period of holding period, it is still okay because you will still see a positive return on your capital. So let's have a look at these 4 scenarios in depth. Now the first type is of course the worst case scenario. As you can see, let's say if you were to purchase a property for 2 million, you hold a property for 5 years. And you were hoping for at least a 5% per annum appreciation, but it didn't happen. 5 years later, you still sell at $2 million. So what's going to happen is that this also is a property that perhaps you have purchased it without looking at some of the 7 analytical factors that later... Win? Talk already, right? Oh. So perhaps you also didn't take note of the 7 analytical factors in our PLB mode analysis. But if you have missed it in our previous webinar by you, Rong and George, later Wayne is going to touch on the 7 factors for you. If you follow that 7 factors, we are very, very certain that in terms of rental, it will be quite strong. In terms of vacancy period, you'll be low, and it's easy to find a tenant. And most of the time, you will be able to write on inflation, whether it's rental inflation or price point inflation. So if you look at this, you purchase at $2 million, you put in 100,000 cash, 400,000 CPF, you use another 69,000 CPF to pay for the stamp duty, and then of course all in, you put in 572,000, you loan 75%, and your rental is 5K. MCST is $450, your monthly installment is 7.5, all in. After factoring your rental receivable, you still have to top up 2,959 per month. And this is your total outlay. At the initial point, after 5 years, what's going to happen is that if you were to sell, we're factoring all the costing already. Agency fees, let's say you get a broker to sell a property, you happen to exit after 5 years. Outstanding bank loan after 5 years, you use your CPF and accrued interest. Rental agency fee to rent for that 5 years. Cash proceeds, lessing off all your property tax. And of course, all your cash top up from all this amount over the past 5 years. This is your net return on capital. Technically, you're looking at a negative cash-on-cash ROI. You're also looking at a total cash plus CPF ROI, which is a negative 21%. You still get back your CPF in total, but technically, because you have lumped in cash of about 100,000 at the start, but you're negative 84,000. So basically, it's a technical loss if, let's say, you hit this kind of property type. Now, second type is that if there's no appreciation, you buy at 2 million, you sell at 2 million, but what you will notice that there will be a negative cash-on-cash return on capital because you put in 100,000, you only put in 60, you only get back 66,000. But overall, in terms of your overall capital for your cash and CPF, because of the fact that some of these funds is being siphoned off into your accrued interest, you still get back plus 5%. But of course, this is a scenario that we also want to avoid because after 5 years, basically you're sort of like servicing this property for free. If you divide that 5% by 5 years, every year is only 1%. This will be a better scenario to just get a T-bill or maybe just to leave your money in the bank. So of course, if you hunt for a property without that price appreciation, most of the time, it will not be a very good scenario. And take note, we're not talking about properties for own stay. We're really talking about property for investment right here. Now, third scenario is that if the moment price appreciates by 5% per annum for 5 years, let's say you buy at 2 million, you sell at 2.5 million after 5 years, even if your rental cannot cover, your rental is 5,000, your installment is 7.5, you have to top up another 450 for MCST, you still have to top up 2,959 in total every month. But what you will notice is that if you put in 100,000 cash, 470,000 CPF, loan 1.5 million, this is what you will be getting back. And your ROI is at 64% on your total capital. Your cash on cash ROI will be strong at 304% because you put in 100,000, this is what you'll get back at the end. So the moment price appreciates, things change. And of course, the moment price appreciates plus the fact that renter can cover this a 3-star grade property, basically overall cash on cash ROI will be even much stronger at 455%. Total ROI is at 90%. So based on this 4 scenario, of course, we always want to go for the third and the fourth type because the moment price appreciates, it actually triumphs a lot of different scenarios. So let's have a look at a couple of new launches. Of course, Park SR was one of the clear winner ever since 2019 until today. Most of the owners are sitting on very good margin right now, averaging about 300 over 1,000 to 400 over 1,000, double-digit return on capital. So Park SR ranked by highest profit. You can see some owners actually have exited with about 600 over 90,000 in terms of overall paper gain. Of course, this is before lessing off their buyer stamp duty and other interest costing and etc. So Sterling Residence also one a good performer. And take note for GLS new launches, it's very clear that there's no more freehold GLS. They are all 99 years in nature, and the only way to get a freehold new launch is through en bloc. And for en bloc to happen right now, if you have not seen our NOTG series with one of the the en bloc veteran, Mr. Krumjit, basically now out of 10 en blocs, usually about 1 to 2 en blocs happens because it depends really on a lot of combination factors. So what we are trying to say is that moving on, the natural norm is 99 years new launch that will triumph the scene. Okay, so let's have a look at resale. This is a resale case study. So have a look at this. The launch was in 2014 all the way to 2016. It took about a couple of years for the entire new launch to clear. Probably it's about a 3-year period. So of course, when they TOP, it was over at this period at the range of about 2021. Naturally, the first-hand owners has already seen a profit margin right here. But take note, even if you were to go in as a resale buyer, and you bought this at TOP, that means when the first-time owners collected the keys, you bought from them as a TOP project, you will still see a significant gain up to today's date. So let's have a look at the numbers in depth. So this is from, of course, assuming if you were to buy in at 2021, you already see quite a significant in terms of PSF gain and quantum gain. And we have pumped in these two differences right here. And let's focus on the annualized gain in terms of the year-by-year gain because the holding period is significantly different. So let's say you have bought this property from launch. Definitely, if you look at the quantum gain, very fantastic. And but if you were to divide out by the years of holding period, because they bought in from 2014, 2015, all the way to 2022, 2023, that's a good period of about 8 to 9 years. Their annualized gain is about 4 to 6%. Quantum gain is fantastic. But even if you were to enter at 2019, 2020, you exited after 3 years, your quantum gain, of course, naturally is lower than them. But take note, your annualized gain is pretty fantastic as well. So it also doesn't mean that you always have to go at new launch. Even for resale properties, if you hunt for the right characteristics, you still stand a good chance to see appreciation. So some new launches and some resale will also not see appreciation. Let's have a look at some of the negative case study. So we just want to debunk the myth that it's not really about new or resale, it's about characteristics of the property. So this is a new launch in Newton. It's freehold. So we have selected this because this is 9, 10, 11. Freehold. And maybe some of you might say that, hey, only freehold will see appreciation. Not the case as well. This has negative, this has depreciation basically from the launch date, the TOP date, all the way until today's date. And of course, if you have followed our webinars, there are certain reasons on why this happened. We talk about volume effect, we talk about the amount of transactions, and this is basically the amount of annualized negative gain that the owners have. And sometimes it's because they have hold out for a long period of time. It's from 2012, 2013, all the way until today. It's about 8 years, 9 years, 10 years. Maybe they were just thinking, hey, it takes a long time for this property to recover. Maybe it might recover eventually after another 3, 5, or 8 years. But maybe they're at a life stage that, you know, they cannot wait anymore. They just cut their losses, exit, go for a better performing property. And this is basically a new launch in 9 years, D19, a big project. The buyers who enter first make gains, but the buyers who enter at resale don't see gain. And this is basically the annualized losses basically for some of the owners that enter and exited. New launch at D11, stagnation for the last close to 9 years already. New launch at D19, the same project that we're talking about. New launch 99 in D23. So this is OCR. Stagnation as well over the last 9 years. And then 99 is in D9, CCR, depreciation over the last 10 years. And thus, there are various case studies that we have. So it also doesn't mean that freehold will definitely outperform 99. It doesn't mean that CCR will outperform certain regions as well. So one of the usual case studies we like to talk about is that two properties that is almost the same distance towards the same MRT station. For example, Covent Melody is close to about 20 years already. But over the last 12 years, if let's say in the year 2011, you decide to go for a 3-bedder right here at 1.26, and then 2023, when you exited, you can exit at 1.75. But let's say if you didn't take this route because it's a 99, and maybe your friend says that, hey, just always go for freehold, and you go for a boutique development, which is also about the same distance to the Covent MRT station, smaller project, about 20 odd units. The quantum range, pretty fantastic at the year 2011. PSF also pretty fantastic, freehold. But then you just wonder, hey, why is it that I've stayed here for 12 years when I exited that project? There is a bigger project, 600 over units, just right across the street. Covent Melody, 99 years older than me, I'm freehold. Why is it that they can see a 400 over 1,000 appreciation, but I only see 110,000 appreciation? This has to do with what Wayne is going to talk about, the 7 factors that later he will share with you. And similarly, do not buy with emotions. Always go with frameworks and analysis, and always buy with the exit in mind. Let me hand over to Wayne.
My portion is going to be very important because these will be your guiding principles of how you will access the project and also have a certain level of frameworks to guide you in your selection. So of course, the 7 analytical factors will include the from the very macro factor of URA, the URA transformation plan, parents effect, MRT, rental demand, volume, exit, and lastly, the right entry price. So first and foremost, of course, we always looked at the URA transformation, and that is basically the guiding principle of what's going to happen in your surrounding environment. So when we look at URA transformations, we always want to look at basically what has the URA plans planned for you in the area. So of course, right now the latest master plan is 2019. And right now in 2023, URA is actually going for a draft master plan of the draft master plan where they are actually asking for feedbacks as well. So we are likely going to see a new revision coming very soon. But more importantly, when you look at this kind of transformation, basically when you look at transformation, it means new things in your area. It means probably new amenities, new jobs that's going to come in, or new residents that's going to come in the area, and that basically will gives you a lot more demand, which will essentially meant price growth. So transformation will also have to be in line, right, in a way to your property plans. So like let's say for example, if you want to move into D3, where everybody is talking about Great Southern Waterfront, but we know that Great Southern Waterfront won't happen anytime soon, and likely for the entire transformation in the area to happen, you likely will have to stay in the area for at least 10 to 15 years in order to truly benefit from that. Of course, the other area will also be your Paya Lebar Air Force, Paya Lebar Air Base relocation. So in the immediate vicinity, if you want to truly enjoy the kind of transformation, you probably will have to be in the area for at least 20 years in order to enjoy the benefit. So that is what we meant by being in the area and also your life stage as well. The second analytical factor will also be a parents' attraction effect. And this is actually very important. So as long as you are within 8 kilometers from a good school, you do know and you do see that the price trending will generally always be on an uptrend. But of course, having said that, I think that's also because of the recent MOE changes in terms of the distance and also the enrollment for the phase 2, where right now the distance is actually much more critical and much more important than the alumni status. So that's the reason why right now the school's attraction effect is actually very important and very, I would say, very significant in terms of the price in terms of the guiding principle. So the third one will actually be MRT effect, which is the transport nodes. So I think right now Singapore has transformed into a very much integrated and well-connected public transport nodes. So right now there's your Thomson East Coast Line, where after the introduction of Thomson East Coast Line, areas like your Upper Thomson area, your Lentok area has seen a lot of rejuvenation, has a lot of hype up, and right there about. So as long as you are within walking distance or within 5 minutes away from a train station, you do see that you will see that actually the projects over in those areas will be quite highly sought after, basically more towards the rental play as well. And of course, we all know that the cost of the cost of private vehicles is also getting more and more expensive as well. And we are also seeing an increasing trend of people basically ditching away their vehicles and going for the public transport for being how convenient it is right now. So what we are seeing is also that, as long as your project is within less than a kilometers from a train station, or you do get to enjoy upcoming train stations, for example, those along the Beauty World side, the Bukit Timah area. So that's where the upcoming train stations will also help to uplift the whole entire area. And ultimately, people want to spend more time with their family members and less time in transport. So of course, the fourth factor will actually be rental demand. So this is one area where we need to look at whether it's your project that you're selecting. If you are going for investment project, well, are you within close distance to commercial nodes? So one of them, for example, would be like, for example, your Blossoms by the Park, where it is in a one-off area. And we all know that in a one-off area, you have your Biopolis, your Fusion Police, and your Media Police. And these are the areas where there are a lot of I would say foreign workers, expats that's working, and these are the professionals. So when you're buying into a project in that area, you do know that your target tenants are actually much more professional, and henceforth your rental amount and your rent will generally be able to command a slightly higher premium than some of the other projects in the other areas. But most importantly is that tenants will want convenience. They will also want to be near towards their workplace, and plus the fact that if your project is a big scale project, for example like Park Estar, where you do get a lot of amenities, tenants definitely love to live in an area with high number of facilities, which will also result in a higher rent as well. Alright, so the fifth factor would actually be the volume effect, and this is actually very important when you are selecting, and this is also the factor that differentiates between a leasehold project and also a freehold project. In this particular example, in this immediate area, there are actually two projects. So one is of a freehold project, 164 units, launched in 2015, pretty much about the same time as a leasehold project. Whereas for this is a mega development. That's 1,145 units, is a leasehold. So if you look at these two projects and you look at the numbers and the transactions, you can clearly see that a project of a size 1,145 units, there are a lot of transactions and there's a lot of movements in that development, and which results in a very much higher amount of profits as compared to the freehold project of 164 units. I mean, of course, this project is not of a boutique size. It's still a fairly good size development. But when it compares against towards a leasehold in an immediate area, it does make sense for a buyer in the similar time frame to choose a leasehold if I want to go for the kind of gains as compared to this freehold development. Right, so of course the sixth factor will actually be the exit audience, and this exit audience is something that is very important because, for example, if you want to buy into an area where you want to know that you have future potential buyers that will eventually come and buy your project, this is where we talk about the upstreamers, which is the new HDBs. Basically, we call it upgraders, people who aspires to move from the HDB to a private condominium. This will be your target audience. One very good example will be projects like in the Tampines West area, or even like the Bidadari estate, where your projects like your Woodleigh Residences, your Park Colonial will have an abundance of new HDB upgraders that will be waiting to move into the development. Of course, you also have your downgraders as well, or rather we call them the downstreamers or the right sizing family, where they want to move down from their landed homes to a private condominium, largely because their children may have like grown up and they moved out of the place, and they find that it doesn't make sense for them to maintain such a big house. They want to right size to a smaller apartment for the ease of maintenance. This would also be your target audience as well. So if you're buying to a private condominiums in a landed enclave, right, this is predominantly your target audience that will be coming for you. For one of them, for example, would probably be like your continuum development. So of course, there will also be your evergreen demand where you are very close towards our commercial hubs like the Paya Lebar area or even the Punggol Digital District or even to your Woodlands Regional Business Centre. So this will always be your evergreen new buyers that's always coming in. So the right entry price is also something that's very important because this will means, how much are you going to enter and what is going to be the exit potential for you to exit. And one of the often myths that people always look into when they are selecting a project they want to buy into is that they always think that actually location is actually a very important factor. But in this example they're going to see later on, in this example they're going to see right now, this prime D9 area close to Orchard MRT station, this will be one of the prime area that always people will want to go for. This will be the area that you would think that as a freehold, Orchard MRT station in prime D9, this will be like your gemstone. But if you look at the numbers perspective wise, the annualized return does not really speaks very well as compared to the next example where I'm comparing to an OCR area, not near any MRT station, just probably near an LRT station. But in terms of the unit type, there's 1,100 over units. But if you look at the numbers perspective, you will be surprised to see that actually this project, in terms of location, is not that prime because this is OCR, it's not near towards the train station. But the returns is actually of a positive side for the annualized return. And this essentially means that it's not just about the location, it's about entering to the right price in the particular district that is the more important that you should be considering. With that, I basically sums up the 7 analytical factors that you should be considering when you are actually buying either into a new launch or the resale units in the resale market. In PLB, of course, we have this mode analysis tool that actually help us, that maps out the various factors. And of course, we have 10 factors over here that will help us to analyze all the different condominiums in Singapore, and this basically gave us a very unbiased scoring system that we will actually benchmark against. So one of the example will actually be whether MRT effect, whether it's a project near towards the MRT, the quantum effect, value effect, and also in comparisons, the density effect as well. So if you are interested in any projects, do come to our consultants and we will definitely more than happy to whip out this mode analysis tool to help you to analyze the project of your interest. And with that, we were able to give you a scoring system, a comparisons as well. And this is something that you can take away with you to have a very neutral perspective of what the different projects in terms of scoring as well.
Thank you, Wayne. So you're thinking why we are all speaking so fast because we have a timer here and our producer is doing this sign so that we want to wrap up as much of our content as possible. A little quiz, so to just follow up on the mode analysis as well as the 7 analytical factors, there are certain things that we can go deeper in depth to understand exit audiences and whether a property is a good value buy or not. So a quick quiz, if there are 2 properties in the same district, both are freehold 4 bedrooms, one is a resale property at 2205 PSF, the other one is at 2641 new project. Which one do you think is a better buy? So maybe we can have a 5-second timer and you can key in your responses within the chat itself. 5, 4, 3, 2, 1. Don't need the voiceover lah. So I'm sure that most of y'all at a glance probably y'all would think that since it's the same location, it's not too far apart with regards to age, then probably you want to go for the resale option at 2205 PSF. And now I put the floor plan to showcase these 2 different 4 bedrooms. You can see on one hand, one is 1701 square feet, massive 4-bedder. The other one is actually 1227 square feet. Seems like a little bit more compact size kind of 4-bedroom. And so if you take a look at the bigger floor plan, number one is that what I want to know here is that the size of the property does not indicate how effective the floor plan layout is. So for this 1701 square feet unit, you can see that this is built in the era where there is a lot of bay window and planters. So you can see in every bedroom, there's bay window. Even within the bathroom itself, there's also bay window. So that eats into the effective usage space. Also with a split living and dining kind of layout. So even though it might look 1701 square feet on paper, probably it will not feel like a 1007 square feet unit. Comparatively to a newer unit, there is a 1224, 1227 square feet. Everything is more optimized, no long walkways, no bay window, etc. And so hence you end up with more usable space within this 1227. So once we discount all the bay window, etc., this unit's usable space probably will land up to be 1,005 square feet or lower. And if we were to use the same quantum pricing, which is this 4-bedder because it's larger in size, even though at lower PSF, it was a quantum of 3.75 million. And with the adjusted square footage, now the PSF will bump up to $2,500 per square feet versus the new launch freehold project at 3.24 million for a freehold property. So in this scenario, which one will you now purchase? So I'm sure there will still be both camps. Some will prefer to get the newer 4-bedder brand new launch because it is more effective and you like something that is brand new. And some will still prefer that, hey, even though it's not optimized, but I still like that we can enter at a lower per square feet level. So just to note that in this kind of scenario, what we often think about is two things. We talk about probability of appreciation. So number one, of course, lower quantum entry pricing also means that you will have a slightly wider pool with regards to your potential exit audience. Meaning that if the market is a little bit more stagnant and these bigger quantum properties are not moving up in pricing, this quantum at 3.24 million can still have a good chance to have appreciate for another 300,000, let's say, like in a 3 to 4 year kind of time period. However, let's say this is a strong market, then I'm sure that both properties will move up. So it's more of like how you decide to play the probability game, whether you want to park your funds in a property where you need a certain market condition for you to experience the new appreciation level, or you want to sort of like play a bit safer, such that in whichever scenario, whether it's a stagnant market or whether it's an up market, it still have that chance of price movement. And so this lands up to a conclusion of like, number one is to not fall into what we call the value trap. This value trap, what we see is a lot of times when people just purely compare on paper what is the per square feet of different projects, and generally lower per square feet means a better entry pricing. But what we need to really consider is the overall price quantum as well, not just whether is it a low PSF. The reason is because a buyer's affordability is predominantly based on the full price quantum and not just on the PSF, because whether you want to take a loan, my income is assessed based on my total loan affordability, as well as my down payment funds that I have is based on what is the price quantum and not just the PSF. Hence, to a certain extent, price quantum in the new era post-2013 plays an equal role together with PSF to determine what is a better purchase to go into. Of course, the other one, using the mode analysis, we are able to identify what is the right project to enter. However, it's also important to understand how we can actually do our micro selection successfully by identifying the correct unit within the project itself. And so that is where we use the disparity effect. And we can find disparity with regards to facing as well as layout types within the development. So giving you a very quick example, if let's say this is the site plan of the entire development, and just now let's say we have did a comparison that we prefer to go into a new launch 4-bedder, and these are the available options. So number one, we want to compare. First thing is, if today I want to consider a 4-bedder, what is my 3-bedder comparison and what is their pricing at? So looking at their 3-bedroom premium, which is their 3-bedroom plus like a utility space, 1087 square feet, the price quantum is close to almost $3 million at a PSF of 2751 PSF. And it will make sense that this 4-bedder that we're looking at is only about 300K additional in terms of quantum at a lower PSF. So you can see that when the smaller layout type is a little bit closer, it could mean that the bigger layout type actually has more value down the road when it comes to the resale market. Looking at the other segment, which is the 3+ study with private lift. So the 3+ study with private lift, you can see that there's another layout of similar size like a 4-bedder, but probably a little bit more luxurious. They give a better fittings with regards like marble flooring, as well as having a private lift. Then you can see that the price quantum is higher, and as well as the PS is higher than this 4-bedder, which should also mean that next time, this 3+ study will ensure that your 4-bedder will be easy to exit. Okay? Of course, now looking at the same counterpart of like 4 bedrooms, let's say 4-bedroom over here, we can see this is a landed facing unit. And we also have choices that you can potentially, if let's say you prefer an inner facing unit, how much is the price difference? So we have worked out that there will be another 240K in terms of pricing disparity because sizing is almost similar. What's the main difference is basically, floor level is the same, what's the main difference is basically what it is seeing. And then so now you have another safety net with regards to facing as well. So if somebody prefers a more unblocked, further kind of open view kind of facing, of course I think the landed facing will probably be easier to exit down the road as well. And comparing upstream, which is a more premium kind of layout, what if you compare to the bigger 4-bedroom types of a bigger sizing, which is going at 4.67 million? So when you have this kind of unique scenario that you can identify that the disparity where you are very, very close to a smaller bedroom type, but yet has a good margin to the next bigger bedroom type, then hence it really allows you to capture that very interesting audience when you're trying to resell 3 to 5 years later when it comes to the resale market. It's very easy for resale buyers, right, to do a very quick comparison because they're able to view the units in person, and hence all this disparity that is on paper will shine very brightly and they'll be able to identify which one is a better buy for them. So that's where we want to park and select the correct property even during the launch time, so that to ensure that we have a bigger target audience when we want to exit, and that allows you to actually position yourself to actually achieve more appreciation potential. And the last thing is also to do some counter checks. So especially the higher the quantum property that you go into, you realize that your buyers become more specific and your buyers have certain requests that they want. And so it's very important to counter check what is the buying behavior in the resale market, especially if you're looking for like a new launch. And so giving an example, so as you can see over the last 1 year period, September 2022 to September 2023, if you are looking at properties that transacted above $3 million in District 15, it actually showcased the number of volume of transactions. The first bar shows you the number of new launch transaction, which is about 165, and about for resale is probably about closer to about 135 units. So number one, this chart will be able to tell us that if today we enter a certain quantum at the new launch phase, whether there is going to be good buoyant demand in the resale down the road in the future. So if let's say, for example, you are in a certain district and you have a lot of new launches that are transacting at a very long bar over here, but the resale counterparts of the similar pricing is actually at a very low bar, then that could mean that in terms of the quantum price might be very hard to exit down the road in a couple of years' time. And of course, we want to see that those people who are transacting above 3 million right now in District 15 the same time period, are they mainly buying freehold properties or are they mainly buying leasehold properties? And you can see that there are a little bit more freehold transaction at close to 170 units that is done as compared to the 99-year leasehold, which is standing about 130 plus over units. Okay, and so what it means if we were to break it down further into number one, which of these leasehold properties are new sale versus resale, and which of these freehold properties are new sale versus resale, then you will understand very clearly at number one, under this 3 million quantum mark, if you realize that we were to break it down, most of the leasehold transaction are actually done by your new sale. So you realize that maybe in this district above this $3 million quantum, you might take a longer absorption rate in order to let go of the leasehold property down the road when it comes to resale market, because you can see there is a much smaller proportion, which is about almost close to about 27% as compared to the new sale ones. In this segment, you realize that there are actually more buyers that are buying freehold properties in the resale market as compared to the new launch market. So how I identify this strategy will be, if let's say today I'm hunting for a District 15 investment, and if the pricing disparity is correct, I will probably be more inclined to enter into a freehold properties, because that will ensure that I will have a bigger exit audience down the road. So these are some of the counter checks that we can do as well to see and project your potential demand and absorption rate as covered by Melvin just now. And so now I'll hand over to Joan to cover the last framework, which is the X threshold.
Okay, thanks, Rong, for your sharing as well. So we're down to the last part. We're also mindful of the time. You know, it's getting late into your Friday evening. So just to share one last juicy framework for you before we wrap up the whole session, this last part about X threshold is also our fourth and very final framework that we're going to talk about today. And in fact, this is also a lead on from the framework that we introduced earlier, which is your lease reset calculator. So ever since we started sharing more about the lease reset calculator with our clients, a lot of very inquisitive clients then came back to us. Now, what is the threshold that we should be looking at, right? What is the huge disparity? So earlier on, we also, using the lease reset calculator, earlier on we also shared different case studies on how we use this framework to analyze the PSF entry point for some of the new launches that we've talked about, Amour Residences, Lentor Hill, but exactly how much disparity is considered huge. And here is another example. Again, one of the more recent launches that we've seen this year, Tembusu Grand versus another counterpart, 99 years, the Shaw Residences, almost comparable in terms of the density, the location, and the fact that it's a 99 years. So again, we employed the same calculation, and after resetting back the PSF for the Shaw Residences, you will see that the PSF based on the actual full 99 years is actually 2002 compared to Tembusu Grand, which at that point, when we were doing the calculation, there were units going at 2003 in terms of the PSF. So this actually gives rise to a variance of 3.8%, which in our perspective and our analysis and research, anything that is under 5% is absolutely great and safe as an indicator to enter. Anything that is within 10% is still good as an indicator to consider. So this is something that we would love to share with you. And of course, I think this nicely wraps up all the 4 frameworks that we have shared today in order to decide if a new launch is overpriced. Before we wrap up this session, I think we just also want to emphasize again that all these are tools that we employ, but these are not the only things that we consider. Of course, in our one-to-one consult with clients, we do still have to take into consideration all the financial prudency checks, all the stress tests, the comfort level, whether the family is ready to uproot themselves, etc. as well. So that wraps up my portion. I will invite Melvin to wrap up the session.
Alright, so this is the final portion, and before you leave the webinar, take note that I'm going to share with you the QR code to scan so that you can gain access to all the 87 to 200 overcharges that our PLB consultants have. So more analysis, I think just now Wayne, Rong, Joan has already shared with you in terms of our framework right here to select the right property, whether it's a new launch or resale. It can all be done through our PRB mode analysis and the 7 factors. We also have just recently released the entire MRT network in Singapore based on our mode scoring. So the east-west line is available for download if you were to scan this QR code. Basically what has happened is that we have actually categorized their performance in terms of the final mode score with all the projects that are within 500 meters to all the MRT lines in Singapore. So if you were to scan this QR code right now, you can gain access to the east-west MRT line. You'll be able to see the project names, MRT station, their tenure, completion date, distance, PSF that has been transacted, as well as the number of transactions done recently. And most importantly is to hunt for the one with the higher mode scoring. And of course, if you come to our PLB consult session, our consultants have access to all the MRT stations in terms of their mode report in the entire Singapore. So we also have our signature strategy series, and these are the combination frameworks that we use based on our clients' life stage, their financial portfolio, as well as their plans and preferences. And of course, if you have not subscribed and signed on to our PLB YouTube channels, this is our first channel, PLB, just type our Property Us on YouTube, you'll be able to find us. And of course, our PLB Insights talks about new launch reviews, and as well as Nuggets on the Go, where we banter and talk about different kinds of real estate topics week on week. All right, so once again, thank you for investing your precious 2 hours over the weekend with us. And of course, our team right here, Wayne, Rong, and Joan has prepped a lot of their time together with our research team that's at the back end to invest in all these charts, come up with all the different frameworks and research. And of course, we hope that you enjoy this time together with us, and we hope to see you on the next webinar. Take care.